Yo, what's up, guys? I want to share with you 5 stocks that I believe are really undervalued. I did a lot of research on these stocks, and I'll show you the numbers for yourself so you can draw your own conclusion. Look at our portfolio today. Basically, all our stocks are in the red in this account. So today seems like a pretty good day to buy. Our Moo portfolio was down 2.3% on the day. So yeah, it seems like the market's getting a little bit bearish right now. But either way, let me go ahead and show you the stocks that I believe are really undervalued. I only own one stock that I'm going over on this list, and I wanted to share with you some stocks you've probably never heard of before. Appreciate you being here. Don't forget to drop a like on the video, and let me go ahead and get into the first stock I actually want to show you. So the first stock is actually ticker symbol REGN. You've probably never heard of this one before, but look at their stock price over the past couple months here. They literally went from over $1,000 to the lowest point since then. And here's what's really impressive about this company, and here's why I think they're undervalued. First off, just look at their PE ratio. They're literally trading at 20 times earnings. Their forward PE ratio looks even better. It's 18 times earnings. So they're actually expected to be growing their net income, which is a great sign. Here's their net income right here. They're a profitable company. They make well over $1 billion every single quarter if you average out the 4 quarters. But here's what's really impressive about the company. They're a pharmaceutical stock. They sell, prescriptions and stuff like that. And if we just click on this one right here, check this out. This is one segment of their business. Look at this segment. It's growing like crazy. This is one of the prescriptions that they sell. It's up 800% year over year. Who knows what that's going to be, by this time next year. So we can kind of see all their different segments of their business. Like here, this one's only $32 million. But here's what's really cool about the Moo app. We're actually able to visualize what their revenues are doing and how it's growing by segment. So that's what's cool about this app. But anyway, let me share with you more about their financials. So as we know, they make well over $1 billion every quarter if you average it out. But here's what's also really impressive. Look at their cash on hand. They have practically $10 billion of cash if we round up. They have $10 billion of cash on hand. And look at their debt. They only have $2.7 billion of total debt. So they could pay off all their debt right now if they wanted to. So they're in a very healthy position right now. And because they have so much cash and a little amount of debt, they're actually making a lot of interest. Look at that. And just in the most recent quarter, they made $308 million in interest, which is kind of crazy if you think about that. That's pure margin for the company. And even so, since they don't pay a dividend, which is a little unfortunate, they could easily afford to pay a dividend. But check this out. They're even doing share buybacks. They had that one quarter there where they had to issue some shares, but that's all right. They've bought back that plus more. And here's why I say they could afford a dividend. Here's their earnings per share. Actually, this is their diluted normalized earnings per share, which is even better. They could pay $1 to $2 per share easily, and it'd be, a 10-15% payout ratio. In the most recent quarter, they made $12 of diluted earnings per share. So yeah, very profitable company. I thought the earnings were pretty good, and that's kind of my thoughts on this company. The PE ratio is really cheap. So that's what's cool about Regeneron. And I want to show you the next stock here. So this one's actually in our zero debt watch list. So every stock that you see in here actually has zero debt. And the next stock I wanted to go over, you probably didn't even know this stock was publicly traded. This is the stock that I own on the list. This is Yelp. I didn't even know they were publicly traded till a few weeks ago. And look at that. They're down 3.35% on the day. But if we kind of zoom out, they're down well from their $48 peak up there. And here's what's super impressive about Yelp. Here you got to hear me out on this stock right here. Remember the market cap. Look in the top right. Their market cap is $2.4 billion. So they have $2.4 billion market cap. And look at this cash on hand. They have, we'll just call it $400 million of cash on hand. So a ton of this company's market cap is just a ton of what you're paying for right now is just the cash on hand. Remember, like I said, this company has zero debt, so they're completely debt free. And because they have a lot of cash and zero debt, look at this. This is another company that just makes a lot of interest. They make $5 million of interest a quarter, which is, pure profit for the company. And here's the best part about Yelp. So I know they don't pay a dividend, but look at this. They have $400 million of cash after buying back $65 million of their own stock. Here's what's super impressive about Yelp. They just buy back their own stock like crazy. If we go to their total common shares outstanding, you now own 3.37% more of the company than you did 1 year ago. So it's kind of like Yelp has a 3.37% dividend yield, or a non-cash dividend yield, a buyback yield, which is crazy. So yeah, that's why I started a small position actually here in my Webull account. We got 7 shares in them, just kind of as a joke. I bought it right before earnings. I thought they would maybe go up on earnings. They kind of went up on earnings, but yeah, that's kind of what I wanted to share with you about Yelp. I own this one. I might be a little biased, but those are all the reasons why I bought them. They're debt free. Actually, I didn't even show you their net income or anything. So I completely forgot about that. Bear with me here. So if we just look at this company's net income, so obviously we saw that they're debt free. Look at their net income. It's a lot better than what it used to be. They're more consistent now. They make net income every single quarter. They're a lot more consistent. Look at them the past 2 years. But yeah, the net income was down 38% year over year. But look, it's hard comparison when it was up 5x from the 2 years before that. But yeah, that's Yelp. All right, so that was Yelp, and Yelp had zero debt. And the next stock we're going over also has zero debt. So this is Celsius right here. This company is only worth $6.34 billion now, which is kind of crazy to think. And if we go to this company's net income, here's kind of why they've fallen so much over the past couple months here. If we look at this company's net income, just in the most recent quarter, look at that. I don't know what happened here. They were making well over $50 million a quarter of net income. And now in the most recent quarter, they only made $6 million. And if we look at their top line revenue, their top line sales, it was down 30% year over year. So that's why Celsius fell. It looks like the stock kind of anticipated that drop, so it kind of made sense. But here's what's crazy about the company. If you remember the market cap, it was $6.3 billion. Well, check this out. They have $900 million of cash, almost call it $1 billion of cash, which is almost call it 20% of the entire company's market cap is just cash. That's what you're paying for right now. And that's what's crazy, $903 million of cash. And look at the interest that they're making off their cash. Wow. In the most recent quarter, they made $11.4 million of interest on their cash. That's a record amount of interest on cash. So that's kind of why you'd want to be buying Celsius right now. This is a huge buffer for their market cap. How much lower can they go? I don't really know. The growth did go away with the stock, though. That actually, Celsius could even afford to do some buybacks now. They issue shares every quarter. That's okay because they're a growth company, growth stock. But the growth just went away for Celsius, and that's why they've fallen over the past couple months. So this one, it's kind of like they have a lot of cash on hand, but it's kind of hard to buy them because the growth rate has slowed. So, you got to be careful with this one. If you're going to start a position, maybe start slow, start with a little bit of money, you know, s- start with a little bit amount of money. And then if they drop lower, then you can, double up your position or something like that. But anyway, that's kind of the risk with Celsius. We just seen they lost. I seen them in Costco. I see Celsius, their drinks at Costco and stuff when I was just there. So I didn't realize that they were losing, their pricing power or something like that. I don't know what happened to their sales. I'd have to look more into it. But yeah, that's Celsius. They're completely debt free. So that takes a lot of risk off the table. So this next company we're actually going to go over, if you like dividend yields, this one has a very high dividend yield. This is ticker symbol IIPR. And look at this one. Ever since they reported earnings, they've really fallen. They went from 135, all the way down to today at a new low of $101. So if you like high dividend yields, though, check this out. They actually have a 7.4% dividend yield, which is really impressive. And if you look at the PE ratio, you don't actually look at the PE ratio, but we can still look at it. It's 18 times net income. You actually, for REITs, this is a real estate investment trust, so they actually have to pay out most of their income in the form of dividends by law. So look at this. Every quarter they make, you don't look at EPS, you look at the EPS, which is net income per share. So you look at the net income plus the depreciation and the amortization per share, and that's this down here. They made $2.28 in the most recent quarter, and their dividend is $1.90. So if you're like, that's a really high payout ratio, it's like an 80% payout ratio, they actually have to have that payout ratio because they're a REIT, so it's completely normal. They have a 7.4% dividend yield. But anyway, we can kind of see on a per share metric that they definitely can afford their dividend, but we've kind of seen the growth go away. Look at that. They were growing double digits all previously before this, and now they only grew 1.77% year over year. The balance sheet is really good, though. Look at this, especially for a REIT. They're very under leveraged. So look at that. In the most recent quarter, they made $64 million. I'll visualize the numbers for you. So they made $64 million, and their dividend cost $54 million, which is pretty cool. And if we look at their cash on hand, they got $147 million of cash. So that's actually the highest amount of cash they've had, in a couple years or possibly ever. If we look at their total debt, they only have debt of $300 million. And for a real estate company to have, they could basically pay off all their debt if they wanted. They have half as much the cash of debt and barely any debt. So yeah, that's what's really cool about this company. Look at the total common shares outstanding. You're not even being diluted. You're being diluted 1% year over year. Not that big of a deal. But yeah, you're really buying this one for the good yield. They got a 7.5, or let's double check that again. They got a 7.4% dividend yield. So this one seems pretty safe. The earnings weren't too concerning. It showed a slowing of the growth rate, but still, the dividend yield is very safe and sustainable, especially because they're a REIT. So yeah, that's kind of my thoughts on IIPR, Innovative Industrial Properties. So yeah, that's the real estate company. And the last stock we're actually going to go over is actually another. They're not a beverage company, but they're in the food and snacks industry. This is Hershey's, and look at them. They've really fallen off their peak here. They were over $250 a share. Now they're at $183 a share, and they just reported earnings. So we're actually going to get able to look at their most recent earnings report. So look at them. They've actually bounced up the past couple of days here, like 4 days in a row. That's a very strong uptrend. But I'll be adding this one to my watch list because if they drop, below 175, I'll really consider buying the dip on Hershey's. And look at their net income year over year. So they're really being hit right now from the commodity of cocoa. So the commodity of chocolate, they sell a lot of chocolate, it has gone up like crazy. It's like 10x from like 5 years ago. The price has gone up literally by 10x or something like that. At one point it did. But anyway, that's what's really hitting their net income right now, their input costs. But either way, look in the most recent quarter. They made $446 million of net income. And let's see how much their dividend cost. Their dividend only cost $270 million. So yeah, they have a very healthy, very sustainable payout ratio. Right now, cash on hand, look at their cash. That's a lot of cash. They have $615 million of cash. I know they have some debt as well. So yeah, be careful. Only $5 billion. So they got $5.3 billion of debt. That's not crazy. Not super leveraged. And if we look at their stock buybacks, so they don't really do any stock buybacks. I mean, look at that one quarter though. They bought back $500 million of stock, but that's actually a pretty good thing. Look at that. They do buy back a lot of stock. They don't issue shares is the good part. So you're not being diluted. If anything, they are doing a little bit of buybacks, which is pretty cool. So that's what I really like about Hershey's. I think they have some high quality brands. They own Twizzlers, Reese's, a lot of high quality brands that I think will be here for the next 50 to 100 years. They're not going anywhere. And especially in America, the Halloween holiday really helps out Hershey's. It forces people to buy their product pretty much every year. So that's what's really cool about Hershey's. Also, I want to mention that we go live every single day on TikTok. And I promise I don't mean this to brag, but every single stream, we get like 100 to 200 viewers in there. It's really hype. The chat is super active. So it's a new thing I just started doing on TikTok. So you can follow me, Nathan_Robert. We usually go live twice a day, every single day when the stock market's open. So if you want to hit the follow button, I really appreciate it. And of course, don't forget to drop a like on this YouTube video and hit the subscribe button. But yeah, thank you all so much for watching. I really appreciate it. I'll show you my portfolio right now. We're still red on the day. We have our Roth IRA with Robinhood as well. If you want to download the Robinhood app or even Moomoo as well, this is my favorite app right here. If you want to download it, link in the description. You actually get a 4.35% APY on your cash, no hidden fees, no $5 a month. So my basically $300 of cash made me 3 cents of interest today, which is kind of cool. But anyway, thanks for watching. I'll see y'all later.